All right, so are you ready to dive into some dividend stocks that might just make January 2025 a little bit more profitable?
Let's do it.
We've been digging into an article from the Motley Fool.
Ah, yes.
Yeah, Motley
Let's hope we
Fool.
do them right.
Yeah,
The financial services company.
exactly. Their mission to make the world smarter, happier, and richer.
Lofty goals.
They put out some really interesting stock picks, and we're going to break them down for you.
Sounds like a plan.
And it's an interesting time to be looking at dividend stocks.
Isn't it, though?
The S&P 500 is doing pretty well overall.
It is.
But the average dividend yield, super low.
Historically low, in fact.
Just 1.24%. That's the lowest since 2000.
Makes you think, huh?
It does. That's exactly why those high-yield dividend stocks are catching everyone's eye.
Gotta find that reliable income somewhere.
Exactly, especially in this market.
So what treasures did the Motley Fool unearth?
Well, one of their top picks was Target.
Target.
Yep, Target.
Interesting.
Now they've got an impressive track record. They've been paying dividends consistently since 1967.
Wow, since 1967. That's through thick and thin.
Multiple recessions, oil crises, you name it.
Even the dot-com bubble burst.
Exactly. It's a testament to their stability, wouldn't you say?
Absolutely. You don't just accidentally make it through all that.
And that history, that long, consistent history of dividend payments,
Yeah.
well, it actually qualifies Target as a dividend king.
Dividend king. That sounds impressive.
It is. It means they've increased their base dividend payout for at least 50 years in a row.
50 years straight.
No breaks.
Wow. So let's talk about why Target's looking so good right now.
Okay, so picture this. We're in a bit of a tricky economic spot right now.
We are.
Yeah. Inflation is up. Interest rates are climbing.
Right.
It's putting pressure on the whole retail sector.
A tough environment for sure.
Now you've got the big players like Walmart and Costco.
A giant.
Yeah, they're performing. Well, don't get me wrong.
Right.
But their stock prices are high.
Yeah.
Their dividend yields are low.
Hmm.
Target, on the other hand, they're offering a forward dividend yield of 3.24%.
Wait, hold on. What's a forward dividend yield again?
Oh, right. It's basically the estimated dividend you can expect over the next year,
Based on
the current stock price.
Oh, okay. Gotcha. And Target's is 3.24%?
That's what the Motley Fool says.
Not too shabby.
Definitely competitive, especially when you consider their price-to-earnings ratio.
They're what now?
Price-to-earnings ratio. Or, as the cool kids call it, PE ratio.
Okay, I've heard of that one.
It basically tells you how much investors are willing to pay for each dollar of the company's earnings.
Right.
Target's sitting at a nice 16.
16.
Which is pretty reasonable when you compare it to other retailers.
So they're priced attractively.
It seems that way. But let's not forget about the actual business.
Right. Are they keeping up with the times?
Exactly. And you know what? They are.
They are. How so?
The Motley Fool highlighted their strong growth in same-day delivery.
Same-day delivery.
They're all about convenience these days, going head-to-head with Amazon even.
That's smart. You got to stay competitive.
Right. So you could be shopping at Target anyway.
I do love their home goods section.
And now you could potentially own a piece of the company and get paid dividends for it.
Paid to shop. Sign me up.
And it's not just about the yield either. The actual dividend payout is $1.12 per share each quarter.
$1.12 per share.
That's right.
How does that compare to last year?
Even better. It's up from $1.10 last year.
So they're raising dividends even with all the economic uncertainty we're facing.
That's right. That's commitment to their shareholders.
It really is. And you know what else is interesting?
What's that?
That $1.12 dividend. It only represents about 52% of Target's earnings.
Okay, and what does that tell us?
It means they've got wiggle room.
Wiggle room.
Yeah. They're not overextending themselves to pay those dividends.
Oh, I see.
That's a good sign. It shows financial health and sustainability.
So we've covered Target's history, their dividend yield, their PE ratio, their growth strategy.
It's like they've got a lot going for them.
They really do. Now let's switch gears completely.
Okay. I'm intrigued. Where are we headed?
Let's talk about another company that caught the Motley Fool's eye, Verizon Communications.
Verizon. So we're moving from retail to telecommunications.
You got it. And you know what telecoms are known for?
Stable dividends.
Bingo. People rely on their services no matter what the economy's doing.
True. It's not like we can just stop using our phones and internet.
Exactly. They've become essential.
So Verizon's got a good track record with dividends?
You bet. They've been paying them consistently since way back in 1984.
1984. Wow. That's a long time.
They're clearly committed to rewarding their shareholders.
And speaking of rewards, what about their current dividend yield?
Get this. Almost 7%?
7%. That's almost double what Target's offering.
Now I know what you're thinking.
What am I thinking?
Why is it so high?
You read my mind.
Well, there are a few things going on with Verizon.
Okay, lay it on me.
First, the article mentioned their stock's been down about 28% over the past 3 years.
28%? Ouch. So that's got to play a role in that high yield.
Right. It's like the market's demanding a bigger return to make up for that perceived risk.
Makes sense. But it's not just the stock performance, right?
Good point. We can't forget about the bigger economic picture.
Exactly. Interest rates have been going up.
And when bonds are offering higher returns,
Stocks got to compete.
especially stocks in those defensive sectors like telecommunications,
They need to offer more attractive yields.
to stay in the game,
And then there's always that looming threat of a recession.
which could potentially put a damper on Verizon's revenue growth.
So a lot of factors are contributing to that high yield.
But here's the thing, we also got to look at their recent performance.
How are they doing?
Well, their Q3 earnings report actually showed some positive signs.
Oh, like what?
They had a 2.7% increase in wireless service revenue compared to last year.
Not bad. Anything else?
They've also had 9 straight quarters of strong broadband additions.
So they're holding their own even with all those economic headwinds.
Exactly. And here's another similarity to Target. Verizon's only paying out about 58% of their adjusted earnings as dividends.
Hold up. Adjusted earnings. You mentioned that earlier but didn't really explain it.
You're right, I didn't. Adjusted earnings are basically a company's profits
Yeah.
after they take out any one-time or unusual expenses.
So it gives a clearer picture of their ongoing profitability.
You got it. So back to that 58% payout ratio.
Right. What does that tell us about Verizon?
It means they've got a healthy margin for both sustainability,
Yeah.
potential dividend growth. They're not stretching themselves too thin to pay those dividends.
That's reassuring for investors.
So we've got 2 very different companies here,
Target and Verizon.
both with attractive dividend yields.
And interesting stories behind them.
Target's all about growth and convenience
While Verizon's providing those essential services.
and weathering the economic storms.
Makes you think about your own investment approach.
It does. We've laid out the facts.
Now what?
Now it's time to really dig in and see what this all means for you.
$1 million question. How do these companies fit into your investment strategy?
Are you the kind of investor looking for steady income now?
Or are you more focused on that potential for growth down the road?
Tough choices.
It's all about what aligns with your financial goals.
Exactly. And honestly, that's something we can't decide for you.
Nope, that's all you.
But what we can do is give you the info you need to make those decisions.
Arm you with knowledge.
And you know, one thing that really jumped out at me from the Motley Fool,
What's that?
they talked about both Target and Verizon as potential lifetime income stocks.
Lifetime income.
Yeah. What do you think about that?
That's a pretty interesting concept.
Right.
It implies that these companies are not only doing well financially,
Mm-hmm.
but they're also really ingrained in, like, essential parts of our lives.
It's like investing in the backbone of society or something.
Exactly. These companies provide services that people truly depend on,
Day in and day out.
which creates a certain level of resilience,
Yeah. They can handle a few bumps in the road.
even when the economy takes a hit.
Target. People always need groceries and household goods.
No matter what's going on.
And these days, everyone's online 24/7, right?
It's true. So those telecom services from Verizon, basically essential.
Pretty much.
So you're saying these aren't companies that'll just disappear overnight.
I don't think so. They're pretty woven into the fabric of how we live.
Makes sense.
Yeah.
And that's part of what makes dividend investing so attractive, I think.
For a lot of people, it is.
It's about building a portfolio that just keeps generating that steady income,
Over the long haul.
no matter what the market's doing.
Up, down, sideways.
It's a strategy that really prioritizes stability,
And reliability.
which can be really appealing for folks thinking about retirement.
Or even just wanting a little extra income now.
Like creating your own personal pension plan almost.
Right. You invest in these companies.
And they basically share a little piece of their profits with you.
regularly.
Exactly.
Yeah.
That regular income can give you a sense of financial security. Now, obviously, no investment is completely risk-free,
Gotta be realistic.
but both Target and Verizon have those long histories of dividend payments,
What we talked about.
which is a pretty strong signal that they care about their shareholders.
They want to keep them happy.
And their financials, they're looking good.
Yeah. Their current performance seems solid.
We dove into their payout ratios,
Their earnings growth.
their overall strategies.
And both companies seem like they're navigating this economic uncertainty pretty well.
So as you're planning your investments for 2025,
And beyond?
think about how these dividend stocks might fit into your picture.
Do they match your risk tolerance?
Do they meet your income needs?
These are the key questions to ask yourself.
We've thrown a lot of information at you today.
It's true.
But here's one final thought to ponder.
Okay, hit me with it.
Remember, the Motley Fool only highlighted these two companies.
Right.
There could be other companies out there
With similar profile.
that actually fit your needs even better.
How do we find those hidden gems? It's like we've given you a flashlight to explore this whole cave of dividend stocks.
Love that analogy.
We've pointed it at a couple of interesting paths.
But there are tons more to discover.
That's where the adventure begins.
All right, so as we wrap up, what are the big takeaways here?
Well, remember what we talked about?
A company's dividend history
Their financial health?
and their position within their industry.
All super important.
And don't forget the big picture.
Think about how the economy might impact a company's ability to maintain and grow their dividend.
That's key.
But most importantly, align your investment choices with your own goals.
And your risk tolerance.
Absolutely. We hope this deep dive has given you a solid foundation to build on.
Happy investing, folks.
And remember,
The journey to financial freedom,
it's a marathon.
not a sprint.
It's like we've given you a sneak peek at two potential dividend superstars.
We've shown you the ropes.
But remember, there's a whole world of dividend stocks out there.
Waiting to be discovered.
Yeah.
And remember,
That's that.
investing isn't one size fits all.
Oh, yeah.
What works for your neighbor might not work for you.
Different strokes for different folks, right?
Exactly. That's why it's so important to do your own homework.
Your due diligence.
Think about your own goals and your own comfort level with risk.
And then see how those dividend stocks could maybe play a role in your overall plan.
It's all about finding the right fit.
Okay, so let's do a quick recap.
A recap.
Yeah, just to refresh your memory on those key things to look for when you're researching those dividend stocks.
Sounds good.
First up, that dividend history.
Oh, yeah. That's a big one.
Have they been paying those dividends consistently?
For a long time.
Exactly. And have they been increasing those payments over time?
That shows commitment.
Right. It's a good sign that they're taking care of their shareholders.
All right, what's next?
Then you got to peek under the hood.
Under the hood.
Yeah, look at their financials.
Makes sense.
Make sure they're in a good spot financially.
So they can keep paying those dividends.
Exactly. Look at their earnings growth, how much debt they have, their overall profitability.
And nitty-gritty.
And don't forget about the industry they're in.
Oh, right. Good point.
Is it a stable industry?
With consistent demand.
Or is it more volatile? You know, susceptible to those big disruptions?
That can make a huge difference.
It really can. The answers to those questions,
What do they tell us?
they'll give you a good sense of the company's long-term prospects.
Their potential for the future.
And the final takeaway, always remember,
Always remember what?
align your investment choices with your own goals and risk tolerance.
Can't stress that enough.
There's no magic formula for success in the stock market.
Nope. If there was, we'd all be rich.
But by doing your research and making informed decisions,
You can set yourself up for success.
you can put yourself on that path to reaching your financial goals.
It's a journey.
We hope this deep dive into dividend stocks has given you the knowledge
And the inspiration.
to start building your own dividend portfolio.
It's exciting stuff.
Remember, investing should be a journey, not a race.
Slow and steady wins the race.
So take your time,
Do your homework.
and most importantly, enjoy the ride.
Words to live by.
All right, folks, that wraps up our deep dive into dividend stocks.
We hope you found it helpful, and we'll catch you on our next deep dive.